Hello, my name is Daryl, and I'm a retired investor who manages our family's investment portfolio. Currently, our portfolio is targeted toward income-producing holdings to provide living expenses for the years between early retirement and our full retirement age, when I will begin collecting Social Security benefits. At full retirement age, Social Security will reduce the need to focus primarily on an income-producing portfolio toward more of a growth-oriented portfolio. In my portfolio, I have several real estate investment trusts. I started and have been adding positions over the last 4 years. Last year, the REIT holdings represented about 17% of my overall portfolio, but is currently about 22%. In June 2024, about a year ago, I shared a video outlining my REIT portfolio and my anticipation of price targets through December 2025. So today I want to take a look to see how the REIT portfolio performed over the last year and revisit price targets over the next year or two. Let's get started with a look at the REIT portfolio performance from the time that I posted the last video on June 21st of last year through the close on July 3rd when I'm preparing this video update. So we'll look at the 7 REITs that I own in the REIT portfolio, which is Agree Realty, EPR Properties, Medical Properties Trust, NNN REIT, Realty Income, VICI Properties, and WP Carey. On June 21st of last year, the price of ADC was $58.75. I had an average per share cost of $58.77. The price on July 3rd close was $71.97. I had an average cost of $61.63 on July 3rd. It is a weighting of 13% in my REIT portfolio. The overall price change over this time period was $13.22. So the price return was 22.5%. There was a dividend of $3.03 per share paid out. So when I multiply the price change plus the dividend multiplied by the weighting in my portfolio, it contributed 3.5% for this past year. ADC has a dividend yield of 3.99%, and my yield on cost is 4.66%, and the position has a total return, including any sales and purchases that I made as I trimmed as it went up and bought as it dropped down, resulted in this position in my portfolio increasing by 27.4%. For EPR, the closing price on June 21st of last year was $37.71. My average cost was $43.24. The price on the July 3rd close was $59.50. My average cost per share was $42.87 at that point. The weighting in my portfolio was 6%. The total price change was $21.79 per share, giving a price return of 57.8%. Paid out a dividend of $3.46 per share. So the REIT portfolio weighted contribution was 4.1%. EPR does pay a yield of 7.26%. My yield on cost is 10.08%, and the portfolio change was 69.2%. MPW last year was $4.49 at the close. My average cost is $5.41. The price at the July 3rd close was $4.38, and my average cost stayed the same. I didn't trade any shares of MPW last year. It's only 1% of my portfolio. The price change was a loss of 11 cents per share, or minus 2.4%. It did pay out a dividend of 32 cents. So the weighted total was 0.1%. The yield on MPW is 8.9%, and my yield on cost is 7.21%. So it resulted in a total change in the portfolio of 6.2%. NNN REIT closed at $39.99 last year. My average cost was $43.90. The price at the July 3rd close was $43.51. My average cost was $43.63. It's a 13% weight in my portfolio. Had a $3.52 price change, which was 8.8% contribution for this year. The dividend was $2.32 for a weighted benefit of 1.8%. NNN pays a yield of 4.84%, and my yield on cost is 4.83%. So the total portfolio change was 14.1% overall. Realty Income closed at $50.05 on June 21st of last year. My average cost was $60.84. The price on July 3rd was $57.68, and my average cost, despite doing some trades during the year, remained at $60.84. It is a 47% weighting in the REIT portfolio. Price change was $7.63 for a price return of 15.2%. They paid out a dividend of $3.19 per share for the year. So my weighted total was 10.2%. They pay a current yield of 5.29%. My yield on cost is 5.02%. And the return in my portfolio, it's actually up 21.3% for this year. VICI closed at $26.63 last year. My average cost is $29.72. It closed at $33.43 on July 3rd of this year. My average cost has been reduced to $29.04. It's a weighting of 16% in my portfolio. Had a $6.80 price change over the past year, given a price return of 25.5%. They paid out a dividend of $1.73, providing a weighted contribution in my portfolio of 5.2%. They pay out a current yield of 5.25%. My yield on cost is 6.05%. And overall, the position is changed or increased 32.1% in my portfolio. WPC closed at $51.15 last year. My average cost is $65.95. The price on July 3rd was $63.23. My average cost is $69.03 per share. It's a weight of 4% in my portfolio. The price change was $12.08 for a price return of 23.6%. They paid out a total of $3.55 per share in dividends. So the weighted contribution to my portfolio is 1.3%. WPC pays out a yield of 5.45%. My yield on cost is 5%. So the position is changed in my portfolio by 30.4%. So if we sum the weighted total average, the performance over the past year has been about 26.1% overall. And in my portfolio position changes, the portfolio has increased by 54.1% overall. Before we start looking at the individual REITs in Fastgraphs to look at expectations over the next year or two, I want to spend just a couple of minutes talking about how interest rates affect the returns on a REIT. So on this chart, I'm looking at 10 years of data in a monthly view. I have the monthly price somewhat dimmed out behind, but then I have a 12-month average just so we can see the general trend of the pricing. I also have the 10-year yield. So in 21 through 23 is when the Federal Reserve really started increasing the funds overnight rate, which drove up the yields across the yield curve. But we can see the general trend of the 10-year yield, and this is what REITs are often judged against, because that's where they need to borrow money to expand their portfolios. Well, you'll notice as the Fed started increasing those rates and the 10-year started to increase, we saw an inverse correlation in the pricing. So as rates went up, the price of Realty Income went down. We can also see that in the 12-month average price, the red line is starting to trend down. And we can also see that the money flow back in 2019 was pretty high and then has basically been trending down to where it was negative in 2024. And that's basically due to the interest rates. And as talk now is increasing about interest rates coming back down, we're starting to see money flow back into REITs somewhat. We're also seeing the correlation and the pricing move higher. So overall, this tells me that as we are moving into a lower interest rate environment, that we can anticipate that the pricing of REITs would increase as people move out of lower yielding treasuries into a higher yielding investment such as REITs. If we look at the CME FedWatch tool, the probability of a Fed rate decrease in July has really decreased. It is expected to be the same as it has been, and that was after the recent jobs report that showed some strength in the jobs market. but there is a probability, a higher probability of a reduction in September, and then again in November, none in December, one in January of 2026, followed by another in June of 2026, and then again in September of 2026, where the federal funds rate would decrease by about 175 basis points, it looks like at this point, with the probabilities of this CME FedWatch tool. So as interest rates come down, we would expect that people would be moving from lower yielding treasuries and bills and bonds to more income producing equities like REITs. That's my expectation moving forward. I'll use fast graphs to look at each one of these REITs, to look at the performance over the last few years and what their projections are, estimates out into the future. So let's get started with Agree Realty. If we take a look at some of these fast facts, they're currently trading at a blended price to AFFO of 17.07 times. They have an AFFO yield of 5.86, a dividend yield of 4.27%. Over this 13-year time period, 10 years in the past, 2.5, 3 years into the future, we see they've had an AFFO growth rate of 6.01%. FastGraphs calculates their fair value to be 15, which is the orange line on the chart. And what the market normally prices them at is a 18.35 times price to AFFO. So the market typically assigns a premium to Agree Realty. You can see that for most of this time it has traded at its normal PE or above until we got to the interest rate hiking regime by the Fed and the price declined to below even fair value. So anytime it's trading below fair value, if all the fundamentals are still in place, it looks like a really good time to be picking up shares. And then with the increased talk of decreasing rates, the price did come back up to its normal AFFO. There was some discussion about higher for longer, so the price came down a bit. And then as it looked like the Fed was going to continue with Fed rate cuts, then the price increased a little bit. And then over the last few days, we've had a decrease in the price overall. Agree Realty does have an S&P credit rating of BBB+, and they do have favorable long-term debt to capital of 34.29%. If I add my transactions to the chart, the greens are the buys and the red are where I did some trimming. So I was buying when it was below fair value up to fair value. So it was a good time to be buying into Agree Realty at that particular point. If we look at where the price is today and we run out to the end of 2026, if it gets back to trading at its fair value, we could expect a total return of 21.96% or 14.2% annualized. We'll take a look at EPR in fast graphs. We can see that they're trading at a blended price to AFFO of 11.98 times. They have an AFFO yield of 8.35%, a dividend yield of 5.95%. Over this time frame, they have a adjusted funds from operations growth rate of 2.41%. Their fair value is calculated to be 13.33 times, and their normal price to AFFO is 12.64 times. EPR really struggled during the pandemic because they're an experiential REIT, and a lot of their facilities were actually closed during the pandemic, which really affected the price. So once again, if you had a long-term favorable view of the fundamentals, that would have been a really good time to buy, because they typically do trade at fair value and normal value. After the pandemic started to decrease in severity, their price did increase quite a bit above fair value, but traded sideways for a year and a half or so, and then is dropped and traded under fair value for 2 years or so. And over the last 6 months, they have really shot up in price, getting very close back to their normal price to AFFO and fair value. If I turn the transactions on, you can see where I was buying and selling. I've pretty much been buying under fair value ever since I had my initial purchase. I did do a little bit of trimming here recently, taking some profits after a nearly 40% higher run. We look at the price today compared to the normal price to AFFO by the end of next year. We could expect a total rate of return of about 21.59% or 13.97% annualized. Looking at MPW, we can see that they traded a blended price to AFFO of 8.91 times. They have a AFFO yield of 11.28%. They have a dividend yield of 7.31%. Their growth rate over this time has actually been negative 4.49%. Fastgraphs calculates their fair value ratio to be 15, and the market underprices that at a normal price to AFFO of 12.21 times. MPW is somewhat of a speculative investment at this point. They're in the medical field. They own quite a few hospitals. They had 2 of their clients. At least one went into bankruptcy. I'm not for sure about the second one, but a second one was actually struggling. And that really caused the price over a 2-year period to hit these bottoms of about $3 per share when it had been trading at $23 per share. They are getting these client issues resolved. They have sold some of their hospitals. They've released some of their hospitals. So I do expect them to have some improvement over the next year and a half or so. And if they can get back to trading at their normal price to AFFO, they could reach a price of about $5.92, which would provide a total rate of return of about 47.93%, or annualized at 29.95%. This is one that I'm very cautious with and just holding the 1% of the REIT portfolio. I'm just holding those shares at the moment. NNN REIT is currently trading at 12.85 times. They have an AFFO yield of 7.78%, a dividend yield of 5.33%. Over the time period shown, they have a growth rate of 4.18%. Their fair value is calculated to be 15 times, and their normal price to AFFO is 16.57. So we can see, like some of the other REITs, that as the higher interest rate environment came into play, the put pressure on these prices has made somewhat of an increase as price reductions have been back in play. And then we had a decrease as they went back on hold. And now that they're coming back in play, we're starting to see the price increase somewhat. If I add my transactions to the screen, you can see that I first bought in 2020, which was probably a little bit too early, but I've been holding it since 2020. I've made several purchases and sales as it started reaching some extended pricing. I would trim a bit and then pick it back up as it was coming back down. So that's where I sit. I have an average price of about $43 per share. It's currently trading around that price, but it does have a dividend yield of 5%, a little over 5%. Let's see what expectations we could have from its current price to back to, let's say, fair value by the end of 2026. We could expect a total rate of return of about 29.61% or 18.94% annualized. When we look at Realty Income, they have a blended price to AFFO of 13.65 times at the moment. They have a AFFO yield of 7.33%, which indicates that it's trading in value territory. And it has a dividend yield of 5.6%. Over the time period shown, it has an AFFO growth rate of 4.67%. Their fair value is 15 times, and their normal price to AFFO, the price that the market applies to it, is 18.29 times. And like every other REIT, when the interest rates started increasing, the price of this particular REIT decreased. As we're moving into a lower interest rate regime, my expectations that it could return to fair value, which would be a 22.92% rate of return or 14.6% annualized. If it would get a little more aggressive and go back to normal price to AFFO, that could take, in my opinion, out to 2027, but we'll look at it for 2026. Then that would be a 48.17% total rate of return or 29.9% annualized. We look at my transactions. This is also one that I bought into a little bit earlier. I should have waited until after the interest rates had kind of peaked out, but I was buying as early as 2021. But I'm holding this. The income is good. It provides a monthly income in dividends. VICI Properties is a relatively new REIT after it was set up from a spin-off of properties into this particular company. They've been trading pretty much at their normal price to AFFO ever since they were created. They do have a blended price to AFFO of 14.5 times, an AFFO yield of 6.9 times, dividend yield of 5.17%. Over this time frame, they have a AFFO growth rate of 21.05 times. Their fair value is calculated to be 21.05 times, and their normal price to AFFO is 15.68. If I add my transactions, I've been buying this one since December or so of 2021, right at the end of 2021. And I've been steadily adding to this position as the price indicated some potential bottoms. And then I did do some trimming at elevated prices. And then as the price started to come back down, I added back to that position. So I've got an average cost of under $30. I think it's $29 or so. We look at where we think it could go over the next year and a half from the current date. If it continues to trade, get back up to its normal price to AFFO, we could expect a 22.92% total rate of return, or 14.9% annualized, 14.8% annualized. WP Carey currently trades at a blended price to AFFO of 13.2 times. They have an AFFO yield of 7.58%, a dividend yield of 5.69%. Over this time period, they've had a growth rate of under 1%, sitting at 0.72%. Their fair value is 9.94 times, and their normal price to AFFO is 13.48 times. During the interest rate hikes, they took a pretty sharp dive. They also did a spin-off of their office properties and cut their dividend, which created some negative sentiment. So this is one that I'm just holding right now. It pays a pretty good dividend, and I'm just waiting for the sentiment to improve and get trading at a little bit better prices. So you can see that I did not do very well on my buying in this particular REIT. I did a lot of buying at some pretty high prices. Also did a little bit of selling and trimming. I did buy some at the bottom of the price back in 2022. But in general, this is one that I haven't done very well on as far as trades. If we look at where it might be trading in the next 18 months or so, if it can get back up to its normal price to AFFO, we could expect about a 16% rate of return, 10.95% annualized. I want to take a moment and thank you for stopping by my channel. I hope this video has been helpful to you. Will you please take a moment and subscribe to the channel? Press that like button to help support the channel. We'll talk to you later, and I hope you have a great week. Thank you. Bye.